Over the last few years, I have seen a lot of people quitting real estate. I've seen people stop closing deals. I've seen people fire sale off what they have. I've seen people that have gone full time into the industry go back into their prior industry to get food on the table, money back in the bank account. I've seen people run from investors. I've seen people run from banks, foreclosed on, giving properties back, total demolition of what they built. The times are pretty hard out there right now. I don't want to sugarcoat it. I had some hard times back in 2008, 9, 10. I had a construction company. I was building custom homes. I graduated college in 2006. Immediately started to make good money. You know, it was easy to build. It was easy to build specs. It was easy to get jobs. I was making, six figures right out of college and thought, oh, well, this is how life goes. I guess it's only going to go up from here. And then, 2009, 10 came crashing down on me like a hammer. And before you know it, I'm literally knocking door to door, installing security peep sites, trying to get people to let me replace their windows or siding or really just do anything to pay my bills. And I got behind on my credit cards. I owed the IRS $15,000. I had a property tax lien on my primary residence that if I didn't pay, it was going to get literally sold at the tax auction. I'm going to lose my house. So it was bad back then. And I was very, very tempted to quit and just say, you know what? This is too hard. It's too hard running a company. I'm going to just go get a job from somebody else and I wouldn't have all the pressure and stresses of this. But I knew that if I can just get through this hard time, if I can just survive this, it's not going to last, right? And as I'm 42 years old, I'll be 43 in November, and I see these cycles. Like I've lived through a couple of them now, and I'm sure there's going to be more to come. I've seen really, really hot markets, really, really good times where literally you're throwing a dart at the wall and you're making money. Money's just pouring in. I've also seen it where no matter what you do, it's like pushing a pile of spaghetti up a hill. It's just nothing is working for you. Nothing's coming together. Everything is difficult and everything is hard. I've been in this industry for 13 years now, buying real estate, buying rental real estate, and longer than that, in construction and all that. And this is some of the hardest times that I have seen. These last couple of years have been very, very difficult, even maybe greater than 2008, 2009. In terms of like transaction volume, that's one huge thing that's lagging. Houses are not selling. The housing market drives a lot of the economy. We saw a bubble in real estate. In COVID, there was just money dumped into the economy. Interest rates were slashed. Prices of everything, cars, food, houses, commercial real estate, everything just ballooned out of control. And those were one of those, quote unquote, good times where I was getting into real estate, heavily into commercial real estate in 2018, 19, and rode that wave up and thought I was smart. I really did. I was like, man, look at how successful I am. Everything I'm buying is going up in value and we're getting higher rents and I'm just the golden boy. But I thought kind of back to, well, remember 2009, remember 2010. What goes up must come down and what goes down must come back up. So trying to insulate myself in the good times to don't go crazy, protect, save for a rainy day, put yourself in situations where you can survive long term because there are going to be cycles. There are going to be hard times and there's going to be good times. Another thing is 2 to 3% interest rates on commercial debt and also on more so on residential houses where people are locking in these 2.25%, 2.75, 30-year mortgages. And even though that was great at the time, it was kind of like a poison pill for the housing market. Because a lot of people now, they're in these houses, they've got a great mortgage, they want to move, but the prices just aren't there. And for them to sell, they've got to give up that rate and go get a 6.25%, 6.5%, 7% interest rate, double their payment, for the same house. And so that's constricting transaction volume. And when transaction volume constricts like that, think about all the people that it affects. It affects title companies. It affects lenders. They're not making loans anymore. Loan brokers aren't getting deals done. People that are trying to wholesale these houses, flippers that are trying to flip houses. Like if they aren't confident that they can get that sold on the back end, then they don't want to flip and they don't want to buy from the wholesaler. And so the whole kind of chain is grinding or has ground to a halt here. And I see it in commercial real estate where we were taking on low debt, and so we were able to pay higher prices because the debt would support it. The debt service coverage ratio was there. We could cash flow these properties. But, when you go to sell, well, the next guy can't get the debt that you had on it. He's got to pay a much higher rate. Or when you go to refinance, now all of a sudden you can't get a 3.5% interest rate. It's going to be, 6.5%, which in a large, $3, $4, $10 million loan, that's a massive swing going from 3.5% to 6.5%. And so as this transaction volume slows down, right, and I'm dealing with it on a property I own in Moline, Illinois. It's 113 units. I've had this deal for 4 years, and it was supposed to be a quick in and out flip. It was supposed to be 1.5, 2 years, repair, renovate, fill it up, and sell it. But we took a little longer on the renovation and we ran out of time. And the Fed started raising rates and raising rates and raising rates, and the cap rate started to expand in that market. And so even though we hit all our numbers, actually exceeded our pro forma on our rents, we're collecting $82,000 to $87,000 a month. And when we bought it, I think we were collecting like 45, 50. So huge improvement. And I'm looking at just breaking even on that deal, getting my investors paid off and getting my loan paid off, and maybe a little bit of money to be made there, but it's just not there because of what has happened over the last couple of years. So the cause and effect of all these things kind of coming together, COVID happening, which made the government freak out, pause everything, hand out billions or maybe trillions of dollars in SBA loans and EIDL loans and PPP loans that you didn't have to pay back, and dumping $8,000, $9,000 on families a couple times a year, ballooned the inflation out of control. And I mean, COVID was a crazy outlier anomaly. And then we've got this massive inflation, and because they're lowering rates to try and, keep the economy on track. We don't want to go off into the tank. And then, knee-jerk reaction. Okay, let's raise the federal funds rate by 400 basis points over the next 18 to 24 months because we got to curb inflation. We can't let this thing run away. And so when you bring all these factors together, it has made for a really, really hard 2 to 3 year time frame. So here's my encouragement to you. Number one, if you are still around, and you're still in real estate and you're still out there making it happen, making offers, buying property, and have survived this period or even expanded in this period, my hat is off to you, because that is not easy. And I have seen a lot of people hang it up, quit, be like, this is too hard, this is too much, I don't want to do it anymore, I can't handle it, right? So if you are still in the game, like me, I've been in this game now 13 years. That's a large portion of my working life. And I plan to be in this game till I'm about, 80 years old, I hope, if I last that long. I plan on being in this game a lot longer. But if you're still in this game, mega congrats, give yourself a pat on the back, because what goes down must come up. In the last 12 months, 14, or I'll say 12 to 24 months, I didn't close a ton of deals, but we still closed some. We sold a few off that were dragging our portfolio down. I closed a 280 unit in Columbia, South Carolina. I closed the 108 unit in Houma, Louisiana. I closed a dental office in James Island, South Carolina. I closed a little retail office in my town of Summerville, South Carolina. And now I'm under contract for 4.5 acres on a 38,000 square foot flex warehouse industrial space to build that out. And so even over the last 2 years, I have still continued to push forward. And the deals that I made, I had to make them work with the economic situation that we're in. I had to make them work with 7-8% interest. I had to make them work with the difficulty in raising investor capital in this environment. I had to make them work with everybody wanting way too much for their property and not wanting to sell. I had to get creative. Some of those deals, I did creative structure. Some of those deals were product of divorce. Some of those deals were a product of a very distressed seller situation, but still finding those little diamonds in the rough, searching them out and buying them. So if you're still in the game and if you have still been transacting and making stuff happen, whether buying or selling over the last 2 to 3 years, hats off. Major congrats. Number 2, if you're new to the game, if you've just started in the last, 12 to 24 months and you are making progress or you haven't given up, even more congrats. Because if you're making it work right now, you don't even know what the good times look like. You don't know what it's like to have people calling you and making outrageous offers on your property, to see the Fed dropping rates, to have banks calling you to refinance where it can save you $10,000, $15,000 a month in your debt payments. And now your NOI is, and your cash flow is going through the roof, and people are just euphoric over real estate and appreciation and development and everything else. You don't even know what it's going to be like. If you're making it work right now and you just got into real estate in the last, I'd say 1 to 3 years, keep going, hang on. Good times are ahead for you. And number 3, if you've given up, right? You may be listening to this episode and being like, hey, that's me. Things got hard and I've given up. Guys, I'll say in a way, I gave up too. About 3.5 years ago, I was in real trouble. I had 3 deals on bridge debt. 2 of those deals were floating rate. Bridge debt meaning a 24-month time frame on this debt, which is not long enough in multifamily. And, I'm sitting there with my cousin Yaden, and I'm like, dude, we're not going to make the turn on these. We're not going to stabilize them in time. We're not going to be able to refinance them. The rates keep going up. Like, this is a dire situation. And we pivoted and we sold off, one actually at a profit. The second one we sold at break even. The third one we were not able to sell, but we were able to refinance out of the bridge debt and get that expiration off of our back. And at that point I was like, dude, I'm done. I am done with it. This was so scary. This was so stressful. This was so hard. We grew really fast. Times were good. We got, I don't want to say drunk, but drunk with the success of what we were having. And we got careless. And we made some mistakes there. And the market pulled back and it exposed some of our shortcomings. We weren't geniuses. We had gotten lucky. We timed the market well, but persisting there, right? And I was like, dude, I want to sell off as much as I can. I don't want to buy anything else. And this is just too difficult. And I sat in that for probably 6-8 months, just kind of paralyzed of like, man, do I really want to take on, I just didn't have the stomach to take on more risk. So even though I maybe never publicly said that, like there was a time frame there for about 8 months where I really did quit. I was like, I'm just selling stuff off. I'm not interested in buying more. This is not fun. This is too risky. This is too scary. This isn't for me. And if you're in that position right now where you're like, man, I'm trying to find a deal. There's nothing out there. Sellers are unreasonable. Interest rates are too high. Stuff isn't moving. Stuff isn't selling. I can't buy stuff. Like, I just want to give up. Or you have given up. There's still time to come back. There's always time to come back. Because people that are successful, they think long term, right? They think about the outcome that they want and they focus on the habit of that. I talked about that, I think, in the last episode, where they're focusing on where they want to be. They want to be 50, 60, 70 years old. They want to have a 30, 50, $100 million portfolio. They want $100, $200, $300,000 in cash flow coming in every month. They want to be paying down millions of dollars of debt every year and having their portfolios grow in value every time they turn around and open up that mortgage statement. They think about that. They don't think about the quick fix, the temporary pain. What do I need to do right now to get out of this jam I'm in? mean, yes, you do need to do that sometimes. If you're in a jam, you got to put food on the table. You got to put money in the bank. You got to pay those bills. I get that. But let it just be for a season. If you've given up on this is something you're like, man, it's too hard. I don't want to do it. I want you to dig deep. I want you to reflect. I want you to think about the future. Because if you stay on the path that you're on, giving up on real estate, giving up on your dreams, sacrificing that stuff, I don't want to do it, it's too much, it's too hard. What's that going to look like 10 years down the road? What's that going to look like 15 years down the road? What's that even going to look like 1-2 years down the road? Which is where I think a lot of good times lay ahead. Where you're like, man, I had an opportunity to buy that. I had a chance to do this. I didn't stick with it. I didn't make it happen. I failed. And instead of, getting back on the horse and trying again, I just let it fail. And I just kept on going down an unintentional path of ease. So if you're there is still time. There is still time. In fact, it's probably one of the best times to get back on the horse and start positioning yourself to buy real estate. 2026, I'm not a fortune teller. I don't know the future, but I know in watching these cycles over and over again in housing markets, in commercial real estate, in the stock market, in cryptocurrencies, all this stuff, it goes down, it goes up. It goes down, it goes up. It goes down, it goes up. Right now, guys, we're down. There's no sugarcoating it. We're down. But that's good. It's a lot better to buy in the trough than it is to buy at the top. Why does everybody buy at the top and nobody wants to buy in the trough? Because of fear. Are we at the bottom? Is it going to slip further? Is it going to get worse? Am I going to lose my shirt? Man, I'd rather buy at the top. Why do people want to buy at the top? The psychology behind that. It's that confirmation bias. It's that herd mentality. It's everybody's doing it. And what everybody is doing is always wrong. What everybody is doing is always wrong. When people are piling into a specific stock or a specific asset or a specific crypto or whatever, the opportunity is typically gone. It's already over. It's the people that saw the potential of the investment when it was down. Right? That's all we preach in the deal room. That's all we preach in like my mantra of how I buy real estate is buying stuff when it's down. Now, I'm not talking about macroeconomic cycles here, but I'm saying like this property has 20% vacancy. This property is $300, $400 under market rent. This property needs renovations. This property has a value add component where we can add 25 more boat storage spaces. Every time I've done a deal, I've bought it because it had a down component that I could ride it out through time or I could fix that. So right now, when we're down, that's when you want to buy. I promise you, everybody and their brother will be buying real estate in the next couple of years. It's going to come out of the woodwork again, be all over the internet, all these people making money, and that's when you want to be careful. That's when you want to be really selective about what you're buying. Right now, there is opportunity if you're willing to grind it out and find it and make it happen when it's hard to do so that you can either sell or refinance when the market is euphoric. 2026, I believe, is going to be way better. I think we're on the cusp of a real breakthrough. It started September, I think it was 17th, when the Fed met and they dropped interest rates by 25 basis points. I think there's like a 75 to 80% chance they're going to drop rates again in October. They may drop rates again in December. We don't know. We'll see. JP Morgan was calling for 4 rate cuts prior to the end of the year. Either way, Powell is leaving in May. So that's 5 months into 2026. He's leaving. Trump has got 4 or 5 people he's looking at, and all these people are telling Trump, we're going to cut rates. We need to ease monetary policy. We need to lower this. We need to supercharge the economy. And that's because that's what Trump wants to hear. And that's who he's going to back, is somebody that's going to do that. You think about the housing crisis. There are, not enough houses, et cetera, et cetera. Stuff is unaffordable. And there's basically a couple options to fix this. I mean, one is we have massive foreclosures, right? Massive foreclosures, wave of a reset of pricing, right? People can't afford it. There's tons of stuff on the market. People are defaulting on their debt. And because of the defaults, it's just driving the housing prices down by, we need a 35% correction to get housing affordable again. Is that going to happen? Is that a likely outcome? Well, let's look at it. I mean, if you have a 3% mortgage and you really, really want to move, but you can't because you can't get the price you want for it, and you don't have a lot of equity there, but you have an affordable mortgage, $18,000, $19,000, $2,000 a month, and for you to go out and buy another house, your mortgage is going to be $4,000 a month, $5,000 a month. For you to rent something for your family, a 3-4 bedroom house, it's going to be $2,800 to $3,200 a month. So your most likely scenario is you're just going to stay where you're at. You're just going to keep that 3% mortgage. You're going to keep paying, and you're going to stay right put. You don't have a floating rate. You don't have a payment that's jumping all around. In fact, that's fixed for the next 25, 30 years on you. And you know that if you stay there long enough and you hold, you're going to be okay. And that's what people are going to do, because there's only massive resets in the housing market when you have distressed sellers. Looking back to 2006, 7, 8, 9, 10, all that mess that we got into, the reason that happened was because people were getting into bad loans. The rates were moving all around on them. They had zero equity, right? We're still making people put down, down payments. Back then, they weren't even making people put down payments. In fact, some people were getting cash back at closing. They were doing liar loans, stated income loans, where you could just say, hey, I make this. And they would say, oh, you make $400,000 a year? Okay, sure, you can afford this $800,000 house or $1 million house, without checking that. Like, it's crazy to even think that nowadays, but that's what they were doing. And then, with the rates, it's like your payment was $1,900, now it's $2,400, now it's $2,800, and all of a sudden your budget doesn't work for that anymore. With the mortgages people have in place right now, their mortgage is not changing. Yes, there's outliers. There's people that are on weird debt, but the majority of people are in a loan that's like sub 4%. Great loan. And so they're not distressed. Would they like to move? Sure. Do they want a bigger house? Sure. But they're not going to take a $100,000 haircut, lose $100,000 in equity just because they want to move. They're just going to stay right there. So I don't see a 30 to 35% housing market correction happening like we saw in the Great Recession. The other option to do that would be raise wages, right? If we raised wages a ton, then people could afford the new pricing of the houses. But you're talking like 30, 40, 50% wage increase. And I mean, that is also, I don't see as feasible, because to pay all that labor and to pay all those employees, where's that going to come from? I mean, prices are going to have to go up. And so what I think is the most likely scenario to kind of fix this issue that we're in is to lower rates. Historically, when politicians get in trouble, they print their way out of it. They lower rates. They take the easy button. They take the easy road. And they say, we're going to just outgrow it. We're going to just outgrow this with our GDP, and we're going to stimulate the economy. We're going to make more money. And yes, prices are going to go up, but it'll be okay because everybody's going to be making more money. But every time they do that, they devalue the dollar. Inflation is almost guaranteed going to happen. And I think we're on the cusp of another bout of inflation. In fact, Jerome Powell in his last talk said he didn't even mention that the 2% inflation target was the target anymore. He changed the language and said, you know what, unemployment is the most important thing right now. We're not really that focused on the 2% because he knows he can't keep inflation at 2%. To do, what Trump wants and to keep on moving forward, we can't really hold inflation down at 2% anymore. And you may think, oh, inflation's bad. I don't want inflation. I mean, we don't want hyperinflation. But if you hold assets, inflation is not a bad thing for you, because the dollars that you locked in and the basis that you paid for that asset, I'm talking real estate here, it stays the same, right? I've got a $4 million loan on a 73 unit apartment complex that I own, and the rate is fixed at 6.5%, and my mortgage payment is X. I don't know off the top of my head what the mortgage payment is on that. Let's just say it's $24,000. It's always it's going to be $24,000, at least for the next 5 years. It's going to be $24,000, and X amount is going to principal, and those dollars are easier and easier to pay off because rents continue to go up as inflation goes up, but the debt stays the same. The rate stays the same. So the value rises faster than or in pace with inflation. Real estate is the best, I think it's the best inflation hedge there is. And so inflation as a real estate investor is not necessarily bad for you because remember, you're controlling a multi-million-dollar asset with a small down payment, or in my case, I've refinanced, I don't even have any cash tied up in that deal, and I'm able to get the benefit of the inflation and the rising appreciation on leverage. So that is probably the most likely scenario that we are going to see play out over the next 1 to 2 years is aggressive rate cutting, trying to supercharge the economy. Trump wants to look good. He wants to usher in the golden era. And I think that that is the easiest way to do that. He's not going to be able to raise people's salaries by 30, 40, 50%. We're not going to go into a housing crisis where housing prices drop by 30 to 40% because the underlying debt on them is so good and so attractive. We don't have enough distressed sellers. I think the only button that they have left to push is this one. So if you're still in this game, congratulations. If you're new to this game, hang on because things are going to get a lot more exciting and a lot more fun and a lot better. And if you dropped out of the game, we want to welcome you back in, man. There's still time. There's still time to get in here. So wherever you're at in the game, getting back into the game, or just new to the game, we want to see you in the deal room. The deal room is our program where we help people connect with loan sponsors. We help people connect with capital raisers, with partners, people that can help you get that deal done when the rubber meets the road. Anybody can teach you how to analyze a deal. Here's my secret sauce on how we find deals and talking to brokers, et cetera, et cetera. And all that training and stuff is great. But how real players make real deals is through relationships first. You have to get into the room where those people live, where they exist, where they're building relationships with other people that they trust and that they like, so that they can reach down and help you hand up because you're bringing them opportunity. That is what the deal room is at its core. It is a community, it is a tribe, it is a family of people that are doing deals together that actually have the ability to help each other. The deal room has a barrier to entry. You have to already be in real estate. You already have to own a couple rentals. I want you to have some experience. This is not a group for newbies. But if you're looking to scale and grow and do bigger deals and you need help, you need someone to go through your deal with you, to vet those numbers, to make sure that you're not making a mistake and doing a bad deal. You need people to help you raise that money, to co-invest with you. Guys, there's a guy in the deal room. He's raising $1.5 million for a deal he's doing in Tampa. He brought this deal to the deal room, I don't know, maybe 2 weeks ago. And I checked back. He made a presentation. He talked about it. I checked back in with him just yesterday. He said he's only got 400,000 of the 1.5 million left. 1.1 million has already been committed. That's the power of being in the right rooms, connected to the right people, so that when you have something happen, when opportunity and luck intersect, you can capitalize on that. So make it a great week. Stay the course. Good times are ahead. Love you guys. Appreciate you. Talk soon.